Hey traders, Jason from Leavitt Brothers. It's time for an update on my State of the Market series. The market has been relentlessly moving up since early October. In fact, there's been a few studies which have triggered, which point to the steadiness and consistency of the buying pressure not being very common. Things have happened in the last couple months, namely in the last month, which have only happened a couple times in history. But now there are warnings that we should not ignore. Okay, the market is due for a rest, and while many people will blame the virus outbreak in China, the charts would suggest that correction was in the pipeline anyway. So let's go through some charts, and yes, I'll admit these charts are mostly one-sided. They argue for a pullback. I don't want this video to be 20-25 minutes, so I'm not including all the charts. I'm just pulling out a few charts that I commonly use that if you've watched some of these State of the Market series videos, they're the same exact charts. I'm not going through thousands of charts and pulling out like the three that point towards a correction. I'm using the exact same charts I've always used, and there are warnings that we should not ignore. All right, so let's get to it. Overall, the long term seems to be in good shape. Perhaps early this coming week, I will do a video of longer term indicators which point towards the market being in good shape and very likely to continue up even if we do get a correction, but shorter term there are warnings. Okay, so let's get to those. All right, so first of all, this is a kind of a bullish chart. This is the S&P monthly going back to 2007. Good trend up. The 10-month moving average has always been very important, and obviously with the current, moving averages up here, not only are we above the 10-month moving average, but we're as far above the 10-month moving average as we've been in a really long time. Okay, I haven't back checked it, but it's one of the highest prints, certainly going back, more than a decade. Okay, so the market has a cushion to work with. Even if the S&P were to fall, a couple hundred points, 5%, even 10%, it's still not going to fall below the 10-month moving average, which is a really good sign. So overall, the market has a cushion to work with. So don't panic. Okay, if you're a long-term holder, I think you can hold because the market's done so well. It deserves to rest for a little bit. Okay, so now let's get into some of the charts which suggest that the shorter term is not so rosy. All right, so this is the Nasdaq versus the NYSE. The market does best when these two are on the same page. Okay, it might seem like I'm being a little bit nitpicky here. I'm actually not. If you go back and you go candle by candle, if you go to match up tops and bottoms, the market does best when these two are on the same page. When they're both making new highs together, the market continues up. When one of them makes a new high and the other one doesn't, the market tends to reverse. Okay, for example, last July, Nasdaq new high, NYSE lower low. Okay, if you look closely, there are not many of these instances, but at a lot of the turning points, you have one of them making a new high and one of them not making a new high. Okay, so here we have higher high, market continues, and you can continue on and look at that. Well, if you look really closely, we had a slight higher high Friday morning from the Nasdaq, but we had a lower high from the NYSE. Okay, that lack of confirmation tends to lead to a pullback. Okay, it's one of the reasons why a pullback very likely is in order. Market doesn't have to pull back a lot, okay, but it's probably going to pull back per this formation, development, I guess you call it. All right. So next chart is the S&P 500 hourly chart. Okay, the blue line here is the 50-hour moving average. It tends to be a pretty good dividing line. Okay, when the market's doing well, it trends up above the 50, uses it as support. You can see it drop below here, okay, back in early December. But all it did is came down, touched the 200, the red is 200, and then it immediately reclaimed it, got, consolidated here above the 50, and then it took off again. Okay, if you compare that to, say, last September, where, here's the line. So it dropped below the line, came up, got rejected, went below, rejected, and then fell again. You see that sequence here. So I bring it up because we had support right here. It bounced, but then last week we cut out. We went below it. Okay, so if if the S&P could base here and get back above the line, great. Okay, but if the S&P bases here, continues down, comes up and touches the line and then moves down, that's near term. That means bias should be to the downside. Okay, at that point we'll see if the 200 comes into play, and we'll just see what happens. Okay, I'm not going to make any guesses or predictions. I'm just going to say like this 50 on the hourly chart is somewhat of a line in the sand. Okay, if the S&P cannot reclaim that line, then bias remains to the downside. All right, here is the AAII Bull Bear Index. All right, so what I want to point out here is that when you get a lot of bullish prints, it's good to a point, but at some point it's too good, and then the market tends to correct. Okay, so if you go back here to late 2017, early 2018, huge block of prints, and then the market did this. Okay, it was a pretty stiff correction at the beginning of 2018. If you come over here to early 2019, huge block of bullish prints. Okay, this is the weekly charts. This is like 1, 2, 3, 4, 5. I mean, this is probably like 15 weeks in a row we got bullish prints. Only one of them, a couple of them were small, a lot of them were big. And what happened is you got a correction here, a recovery, but then another mini correction. So if anything, you got kind of sideways movement with a slight upward slant. Okay, if you compare that to 2017, and 2017 was an incredibly good year for the market, where the market just kind of steadily moved up. I mean, look at this garbage. You know, good prints, bad prints. And this is actually a pretty good environment to rally from. And the reason why is because all those negative prints are like the proverbial wall of worry. You know, there's enough bullishment to keep it going, but there's enough bearishness to kind of feed the market. And you know, these bears end up becoming buyers later on at higher prices. Okay, so you want more. This is kind of an extreme case. I'd consider it an extreme case. You want more bullish prints than bearish, but the occasional bearish prints are actually really good. Okay, so if I compare it to what's going on right now, so obviously we've had this many weeks of bullish prints. A couple of them are small, but like even the last 1, 2, 3, 4, 5, 6 last 6 out of 7 weeks have been like really big prints. Okay, so this kind of sets the stage for there's just too much bullishness, too much complacency. Everyone assumes the market's going to go up. The market is ripe for some sort of correction here, simply because there's too much bullishness here. Here's the S&P 500. And I'm going to just focus on the middle pane here, is the 10-day moving average of the NYSE advanced decline line. So when the market goes up, you want advancers to be beating decliners by a decent amount, not too much, not too little, but just a decent amount. When you get divergences tend to lead to pullbacks. Okay, so for example, market goes up here, 10-day AD line goes diverges and goes down to 0, and you get a correction. Market comes up here, you get another divergence there. Market was going up here, and we did have a divergence here, which all it did was, it led to like a couple weeks of sideways movement, didn't do too much damage. And now another divergence is forming. The market's going up, 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 and the 10-day is put in a lower high and it's getting close to 0. At the very least, we need to be open to the possibility that, we have at least some sideways movement coming, at most, like a legit correction. Okay? Virus in China or not, doesn't matter. The breadth would suggest that there's less participation. There has been less participation. A little bit of weakness is seeping in, and we should at the very least be careful. Again, at most, we could have a legit correction. The S&P could, easily come down to 3,200, even 3,100. Okay, be open to that. Be prepared for that. Go through your scenarios. If it does happen, it should not be a shock. Okay, this is more of a bullish chart. This is the 80 line for the large caps, mid caps, small caps. In all cases, they're trending up. They're doing great. It tells us that market's well supported overall, even though there's a little bit of weakness in the near term. Like overall, things are going well. So this is one of the things that should provide a bottom for the market when the market does, if the market corrects, this should, support the market on the way down. All right, next chart it's similar to two charts ago with the NYSE, except it's with the NAS and with the 80 volume line. Okay, so got the NAS up here, and we got the 10-day NAS 80 volume line. Similar in concept to what I just talked about. Okay, when the market's trending up, you tend to get, this is like a perfect scenario. Not too high, not too low, just prints kind of right in the middle of the range. There's support, but not so much support that you're going to have a blow off top. High prints are good, okay, but you tend to get a high print followed by a divergence, a month later, and that's what has happened several times. So you can go back to like last April, you got higher high, lower high here, market corrects. Same thing in June, July, a couple higher highs, a couple lower lows from the indicator, market corrected. So right now we're getting, higher high and lower high. So it's another thing to pay attention to. Don't ignore it. Market doesn't have to fall hard. But it is likely to correct unless this thing reverses. Okay, we'll see if this thing if the line could find support at the zero line. That'll be great. If it dips below the zero line, then we're probably in a store for some sort of bigger correction. Bigger correction doesn't mean huge. It just means bigger than just like dropping for a few days or a week. All right, here's the large cap 80 line. Mid cap 80 line, small cap 80 line. Okay, I'm going to start going through these charts a little quicker because I don't want the video to be too long. Okay, large cap line doing great. Mid cap line, small cap line starting to diverge. When you get divergences, you start to get corrections. Okay, higher high here, but this struggled to hit a new high, and then this obviously didn't, and then the market corrected. Same thing over here, higher high. This kind of matched the highs and then started down, and this was already going down. Okay, higher high recently. Mid cap line struggled to match the high. Small cap line didn't even come close. Already down. Okay. In fact, the print rate here is the same as the print from back here. So even though the market has been relentlessly going up since early October, you have prints that are not much change from the small cap line. Okay, just another piece of evidence that says, who cares about the virus in China? The chart would suggest that the market is probably going to correct a little bit here. All right, a couple more. Here's new highs at the NYSE and new lows. New highs recently printed, high number. That's really good. High prints are a sign of strength. Even if the market corrects, there's enough strength built into the market that it tends to find its footing and leg back up. But I want to point out the uptick in new lows. It's not a huge urgency right now, but you have to ask yourself if the market was hitting a new high, or the highest number of new highs just printed last week recently, why are new lows already ticking up? Okay, this is the highest print going back, to early October. You get a little bit more of a push here. It's going to be the highest number since August. So something to keep an eye on. It's one of those things that right now it doesn't tell us a lot, but it's kind of in the back of your mind that like, hey, as one chart starts to turn, another chart starts to turn, and then this one is starting to turn also. And like, who knows? In a week from now, this could be up here and fully supporting a correction. Here is S&P 500 up top. Down below is the 10-day moving average of the put-call ratio. What I want to point out is that low prints on the put call tell us there's a lot of complacency. It's kind of like a low VIX reading. Nobody's buying puts to protect their portfolios on the downside. But as it turns out, that when the 10-day put call drops to a low level and then starts to reverse, there are many instances where the market pauses or actually corrects. Okay, so it happened in early 2018, and obviously we got correction and several months of choppy trading. There are many smaller instances along the way, but the longer prints, we got one here in mid 2014, and we got several months of sideways movement. We got one at the beginning of 2014, and we got a dip there, and that doesn't look like much, but that's 100 points in the S&P, and 100 points in the S&P when it was trading at 2,000 is 5%. We got a dip over here in 2012, and again, that's like a 100-point dip when the S&P is trading at 1,500. That's more than 5%. So a 5% dip right now would be 150 points. Is that right? No. Yeah, it's 150 points. So, we're talking about like possibly dropping, down over to here. Okay. So again, low prints curl up, tend to lead to, at best, sideways movement for a few months, and at worst, like a legit correction. All right, so we should not ignore these signals, okay? If you're a longer-term swing trader, go to each one of your trades, how much, determine how much heat you're willing to take. At the very least, going through the exercise will prepare you for what might be coming over the next few weeks or month, and that'll dampen the emotional extremes that happen. If you're shorter term, then you got to tighten up stops. You got to be a little bit more careful. You don't have that steady wind at your back that's going to definitely rescue your trades. Okay, you don't want to sit in positions if the S&P is going to correct 100 points, 150 points. You just can't do that as an active trader. If you are an active trader, you just can't dig yourself that kind of a hole, because then it'll take too long to dig yourself out on the other side. All right, thanks for listening. You can subscribe to my YouTube channel by clicking the red subscribe button. Check out my Masterclass in trading class at the link below. Thanks again, and I'll see you next time.